With chaos at the New York Stock Exchange.
Get back in there at once and sell! Sell!
We are looking at major records for the Dow.
Now is the time to buy.
Well, the law of gravity hit Wall Street today.
We're down by between 3 and 4.5%. The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
You gonna do something or just stand there and bleed?
The whole town's gone crazy.
Hello and welcome to this week's edition of the Big Money Report. I'm your host, David Booth, President and Financial Advisor at BIG Investment Services. That's BIG, Booth Investment Group. We're full-service financial advisory based out of Dover, Delaware, serving clients all across this great country. And you can read all about us at abigplan.com. That's www.abigplan.com. I like to put this show together once a week just to give you a recap of the week behind and a peek at the week and weeks to come. Trying to keep you up to speed with you and your money. And we're glad you're with us today. It is Friday, March 22nd, 2024. Shout out to Kevin and Cheryl and Robin and Beth and all the folks that tune in week in and week out. Really appreciate the listenership. Markets had a strong week this week, a surprisingly strong week. And we'll talk more about it in just a moment. But the Dow Jones up 1.9% this week. The S&P 500 up 2.2%. The NASDAQ index up 2.8%. And the Russell Small Cap Index up 1.6% on the week. And of course, with the market moving up so strongly, we saw the volatility drop pretty significantly as well. So the volatility index, the VIX, down 9.3% this week, down to 13, almost 13 even. Pretty low level there on the VIX. Long-term bonds also climbed a little bit this week. They were up 1.1% on the TLT. That's an ETF that measures long-term treasuries. Still down almost 5% on the year, but did have a move up this week because rates drifted lower, and there's a reason for that. We'll talk about that also. So looking at the sectors, what we really saw this week were the sectors that would suggest that the economy is still on track, that things are still chugging along, all did well, right? So positive economic growth types of sectors did well this week. And the defensive areas like utilities, staples, and healthcare were all underperformers. So staples were only up 0.1%, utilities only up 0.6%, and healthcare up less than 0.1%, up 0.06%. But we saw a lot of growth areas really do well. Technology up a couple percent, and industrials up 2.5%, financials up 1.5%, energy up 1%. I mean, everything else just did pretty well this week. Gold was up 0.3% and silver down 2%. So what was driving markets this week? Well, there was one major story, and that was the Fed. We'll get to that here in a moment. Let's talk about the smaller things first, which I think are important as well. Economic data just continues to hang in there. And as you take a look at some of the data this week, we had existing home sales much stronger than expected this week. Home builder sentiment really, really strong this week. The Philly Fed manufacturing prices paid, right? So prices paid in the manufacturing sector, lowest since May of 2020. That was a really good number. Bond volatility's been really declining and easing up. We saw FedEx, they had an earnings report here that was just not going to cover off the ball. They had a great earnings report, and that's really involved with the backbone of our economy, if you will. So things look really good with most of the economic data, and that's really a big deal. The big mover for the week was the Jay Powell and Federal Reserve and Company. So they had their meeting. And I tell you, coming into this week, as we've been talking about, the market has looked stretched. It looked like it was starting to roll over. The technical indicators absolutely suggested that the market was due for a pullback. And with the Fed meeting this week, I thought it would probably be a good week for the market to really show its stuff and give us a little bit of a step backwards. So we were prepared for that. We've been doing some trimming for 2 months now. We've been doing a lot of trimming some stocks that were up a lot, and just prepared for this step back that was kind of expected. Did not happen. And it didn't happen because the Federal Reserve continues to tell the market they're planning on cutting rates. I just think this is kind of ridiculous. My career, and actually when you study Federal Reserves throughout history, and no Federal Reserve has ever been so proactive in trying to tell the market the future, especially when it comes to rate cuts and rate hikes and things of this nature. It's really kind of surprising to me that they're holding their guns on this because, as we've talked about, the inflation data has been a bit sticky. The last couple inflation numbers we've got, CPI, PPI, PCE, these three numbers that we pay so much attention to, they've not been great. They've been kind of ticking the wrong direction. And I kind of thought that would give the Federal Reserve an opportunity to maybe talk the market down a little bit, because one of the things that also leads to inflation is the easing of financial conditions. And one of the things that helps to ease financial conditions is a rising stock market. I mean, don't you feel better when you've got more money in your accounts than you had 6 months ago because the market's gone higher? Of course you do. And you tend to feel a bit more comfortable spending that money or some money when you've got more money in your accounts. So this easing of financial conditions tends to lend itself a little bit to inflation, more spending, more inflation. But the Federal Reserve, they didn't take that opportunity to talk anything down. They reaffirmed their expectation to be cutting rates this year. Of course, coming into this year, the market was looking for 6 cuts. At this point in time, it looks like it's pricing in 3 cuts beginning maybe as early as June. The Fed dot plot, this is kind of like what all their little projections are, all the different Fed members, their projections still show them on track for maybe 3 cuts this year. So the market took that as a big positive. Inflation be damned, who cares? The Fed's going to cut rates, rah, rah, let's buy more stock. So that's what happened this week. Does it mean it's right? No, not necessarily. I mean, the market's been dead wrong on some of these things in the past. But for right now, that's where things are. The Fed continues to kind of beat that drum, surprisingly so. Honestly, I'm kind of surprised that they were as positive and dovish is the term we use for a Fed that wants to lower rates and make money a little bit easier. Surprised that they were as dovish as they were this week. So what happened then? The market responded positively. We saw, everything really move higher. And the technicals that we've been talking about for the last couple of weeks were negated this week. All right. So these overstretched signals, these things that really point into the market being in a consolidation phase that may lead to a little bit of a correction, a mild one maybe, but a correction nonetheless, they all got negated this week, which means that the market can go higher. It can go higher from here. And as such, I'm not going to mess around, right? I'm not going to insist that I'm right and the market's wrong. So today, Friday, market stepped back a little bit. So for folks that have added new money just in the last few weeks, we invested a big chunk of it last week when the market was down. I went ahead and invested the rest today. Now, for the model, we still have cash on hand, and I'm going to keep it on hand because the market's going to have something that's going to rock its boat at some point. And when it does, we want to step and do some buying. Not only that, there could be parts of the market that might give us a buying opportunity. I've been watching the XBI, that is the biotech index, which is breaking out, but it's drifted a little bit from its highs here. It's recent highs the last couple of weeks. I like to see it down just a little bit lower from here. I like to buy that. There's a list of stocks that I have that I'm monitoring, that I'm watching, that I'm ready to buy, or existing stocks that we trimmed that I like to add money back to once again. But, we don't want to chase either. The market is really fairly valued right now. When you look at earnings of the S&P 500, you look at the price of the S&P 500, it's hard to see the catalyst to drive the market up significantly higher from here. But markets can be irrational much longer than most investors can stay solvent. That's why we don't bet with money. We just don't gamble, right? We're not going to go all one direction or all the other. We want to maintain balance. We want to maintain a measured approach. We want to keep some money in bonds, keep some money in cash, which we have on hand, looking for the opportunities to do some buying, and they'll come around. They'll happen. May not be a few weeks now, though, based on what this market did this week. We'll see. That's where we are. Things look good. Things look constructive with the markets. The technical indicators that were suggesting things could get sour here for a little bit have kind of been negated with this week's action. So we have reacted properly to that information, and we'll be looking to do some buying with the cash we have in the models when those opportunities arise. So between now and next few meetings, you're thinking about your future, your long-term goals, all the things you want to do with you and your money. Maybe it's retire a little early or just flat out retire. Maybe it's help pay for that wedding or pay for your student to study overseas for a semester. Or maybe it is buy that second house or RV or boat or whatever the case may be. You know what your goals are. Don't just think about it. Think big. Think BIG. And I will talk to you next week.
Thank you for listening to this week's edition of the Big Money Report with your host, David Booth, President and Financial Advisor at BIG Investment Services. For more information on BIG and how you can access their planning and investment management services, visit them at abigplan.com. That's abigplan.com. Or call them toll free at 866-946-PLAN. That's 866-946-7526. The foregoing content reflects the opinions of David Booth and Booth Investment Group Incorporated and is subject to change at any time without notice. There's no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Content provided herein is for informational purposes only and should not be used or construed as investment advice or a recommendation regarding the purchase or sale of any security. All investing involves risk, including the potential for loss of principal. There is no guarantee that any investment plan or strategy will be successful. Please consult a professional before investing.